Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in July. High-grade bond markets did incredibly well for investors again throughout July, helped along by interest rate cuts, firstly at the Federal Reserve, which is something we've been calling for some time, and also here domestically from the Reserve Bank of Australia. It's very likely that both of those institutions will have more to do in terms of their interest rate cutting and accommodation program. Around the world in July, interest rate cuts were also received in South Korea, India, Vietnam, Brazil, Russia. I think you're starting to get the point. In August, we're filming this very early on, we've had a surprise big cut from the Reserve Bank of New Zealand, from India, from Thailand. This is a global phenomenon. Rate cuts are clearly a thing of 2019, and they're coming in spades to really try and reprop a decaying economy that's under real sufferance in the middle of not only interest rates that have risen over the course of 17 and 18, particularly via the US Federal Reserve and lifting that international cost of capital, but now also clearly because of the big step up in the trade war. We've written previously and made other videos about the trade war and how serious we really think it is. Our central scenario is that we stay in a protracted trade war for some time. And I think we're starting to see this get more serious now. And clearly there's also a currency war element to this as well. Trump has been tweeting that nothing is going to get resolved here until after the US presidential elections at the end of next year. I think he realizes that there is no deal here and he needs to play strong arm and try and force the other side's hand. But clearly China are prepared to dig in. And we've written a lot about that in previous episodes. So, just be aware of that because it's going to impact global macro outlooks quite negatively. And that's why we're going to continue to see this very powerful accommodation from central banks trying to maintain the status quo of low growth type outcomes around the world. One thing we also want to point out is, again, we've had a number of property developers and their debt start to freeze up. Now, this is clearly not a result of what's happened since the election, but is a legacy of the difficulties that those markets experienced prior to that time. And it's a stark reminder for investors, particularly in some of these, sexier, higher yielding type offerings, which we see out in the marketplace all the time, that you really do need to be very focused on credit quality and liquidity. Now, that's not to say these aren't good investments. Many of them, of course, will be. But if it's a defend and protect type allocation, just be careful because not only have we seen some offshore credit-based funds freeze up and have problems, this is all ahead of the big recession if we are to have one. These are the little precursors, but they keep popping up and there's never just one cockroach. So please give that vast consideration because if the risk is okay for you, then you should absolutely go for it. But the risk is really quite pronounced at this point in the cycle. And I do think that investors need to understand those liquidity risks and those potential capital risks because late in the cycle, it's return of capital, not necessarily always return on capital. And that's a big, big difference.